And the first item on the agenda is to consider the minutes of June 17th.
I move to approve as submitted.
I'll second that.
Okay, we got a motion and a second. All those in favor, please vote aye.
Aye.
Any opposed? Seeing none. Okay, Natalka, we're starting with you. The first item under your list is the June 2020 Plan Performance Flash Report, Asset Allocation, and Rebalancing Recommendations for the Defined Benefit Pension Plan.
Okay, very good. Well, thank you, everybody, for giving us the time this morning to go over a lot of things. And as Melissa stated, we're going to start with the June Flash Report, and also we were able to get in a lot of your performance numbers into our performance accounting system and provide you with at least your total fund returns and composite returns for your investment management team. So we can talk a little bit about second quarter performance as well. And I'll sort of start off with, my little market, review, which will focus on the second quarter. And this is certainly a more pleasant conversation than the one that we had, at the last meeting when we were talking about the first quarter. Global stocks, as I'm pretty sure everybody realizes, rebounded sharply from a coronavirus pandemic sell-off in the first quarter. All sectors of the MSCI World Index, so that includes the U.S., emerging markets, as well as developed markets, advanced and were in positive territory in the second quarter. But opposite of the first quarter, defensive sectors like utilities and consumer staples lagged the broad markets. U.S. equity markets, which experienced their worst quarter since the global financial crisis in 2008, when they were down 19.6%. In the second quarter, they experienced their best quarter since 1998, rising 21%, despite a spike in COVID cases late in the quarter. Amazingly enough, the index gained 39% from its March 23 bottom. Small caps led the way in the second quarter, rising 25.4%, and just, if you will, edging out mid-caps, which rose 24.6%, and large caps, a very healthy 20.5%. Across all capitalization ranges, the growth style outperformed value, and that differential between growth and value, that gap just keeps getting wider and wider. The market advance was, when you look at the sector performance and such, it was quite broad-based. However, I would be remiss if I didn't say that the top 5 or 6 stocks in the index, so your Facebooks, Amazons, Netflix, Googles, Microsoft, they are certainly driving the market, as is the technology sector in general. And if those stocks were broken out and were in their own index, the broad market performance would have advanced, but it would have been much, much less. So there's still a lot of room to run, if you will, in the value sectors, and a lot of recovery to be had. In non-U.S. markets, both developed and emerging markets outperformed U.S. markets in the month of June, but not quite so for the full second quarter, although developed markets advanced a healthy 15% and emerging markets rose 18%. And you have exposure to both of those segments, and we can talk about that a little bit later. In my write-up for the June and the second quarter, we've put in a number of factors that drove emerging markets. I guess I would summarize it by saying that emerging markets that were driven by oil-producing and industrial metals. So countries that have the largest exposure to that, Russia, Brazil, areas like that, benefited the most and drove the 18% return of emerging markets. In the bond market, it was sort of the opposite of what we saw in the first quarter. It was definitely a quarter where, you did not want to be fighting the Fed. The programs that they introduced at the end of March to shore up the bond market, to provide liquidity to frozen segments of it, and just instill investor confidence that that they were ready to step in if need be, was really all the markets needed to rally. Going from worst to first were credit bonds. High yield bonds rose 9.6%. Investment grade bonds rose 8.2%. The higher quality government bonds and mortgage bonds, which were so defensive in the first quarter, were up 0.5 and 0.7% respectively. So a big catch-up in fixed income for the securitized and spread sector areas. Interest rates had a much smaller impact in the second quarter. In the first quarter, interest rates dropped about 80 basis points. In the second quarter, they rose slightly from 64 basis points up to 66 basis points. So really, in the second quarter, it was all about credit, it was all about the Fed, and much less about interest rates in the fixed income markets. And I'll close with just a few comments on the U.S. dollar. In the second quarter, it weakened versus most currencies as the safe haven buying that was occurring in the first quarter abated. Real assets participated in the rally. The Commodities Natural Resource Index, which sank 42% in the first quarter, was the top performing area in the second quarter, jumping 31% as oil prices rebounded to over $40 a barrel. Global REITs rose 11.5%, slightly outpacing U.S.-only REITs, which were up 9.1%. So that's just sort of a quick review of June and the second quarter. Certainly a much better time than we had in the first quarter. And just a few comments on how the plan performed. You should have a one-page handout of defined benefit plan performance, which has your total plan composite plus all of the sub-sector composites. The total plan composite rose 13.3% in the second quarter, which virtually matched your blended target policy index. Assets were up to $140.3 million. So a nice rebound. You began the year at about $151 million. You dropped March 31st at the end of the first quarter to about $124 million. Pretty, gut-wrenching drop in assets. And you're slowly but surely, and maybe not even so slowly, digging your way out of that hole and back. You're now up to $140.3 million again. So that's good. The plan fell further performance-wise in the first quarter than the blended target index, so you're unfortunately still about 1.8% behind on a year-to-date basis. But many of the areas that were the hardest hit in the first quarter for you were actually your top performing areas in the second quarter. So if you look at the global fixed income composite, was up 4.8% versus a blended target of 3.6% in the first quarter. Your global fixed income composite lagged significantly in the first quarter, but in the second quarter, all 5 of your fixed income managers topped their respective indices, and you've virtually caught up on a year-to-date basis. I would say some standouts in performance were Pinnacle Fixed Income rose 5.2% versus a 2.1 target. They are pretty much all credit bonds, some governments, a couple of municipals, but they're a credit bonds manager on your behalf. The Brandywine Global Bond Fund, which dropped 12%. Let me just check. Let me get this right. 11.2% in the first quarter, rose 10.6% in the second quarter. The weakening dollar and a lot of emerging market debt was the top performing segment of fixed income markets. Your one of your largest managers, TCW Total Return Fund, which is at this point in time about 98% invested in mortgage-backed securities, and the majority of that is in agency-backed mortgage securities. They were your only positive performing manager in the first quarter, up 4%. They added to that with a 3% return in the second quarter. They're well ahead of both the mortgage as well as the Barclays Aggregate Index. So they have done their job. So kudos to TCW. On the global equity, the domestic equity composite, 2 of your 6 managers outperformed in the second quarter. The composite was up 20.6% versus 22.5%. The largest, if you will, detractor was Pinnacle Large Cap Equity. For the second quarter, they rose 18.1%, lagging the S&P 500 20.5% return by close to 2%, or a little over 2%. So year to date, they're right on top of the index, but their performance slowed a bit in the second quarter. In some ways, that's not surprising, because while they have exposure to some of those top 5 or 6 stocks that have been driving the index, they do not hold those stocks in the same proportion as the index does. And other segments of the equity markets did not rise as much. So we'll keep an eye on Pinnacle. They've been just a stellar performer for you during the past 3 years. So, but as your largest equity manager, when they underperform, it's difficult for the rest of the domestic team to make up the ground. The other significant laggard in the second quarter was Janus Enterprise, which is your mid-cap growth manager. They rose only 23.2% when the mid-cap growth index rose 30% in the quarter. So that lag also held you back, but they're a much smaller manager from an asset perspective. So, all of it, aside from 2 of your managers, well, I should say 3 of your managers earned well over 20 and 30% for the quarter, and the others were like at 17 and 18%. So strong absolute returns from the domestic equity team. International equity rebounded again, and 3 of your 4 managers outperformed. American Funds World Growth and Income, which is a global equity manager, lagged slightly, up 18.4% versus 19.2% for the index. But all of your other managers, Janus Global Research, Dodge & Cox, and your emerging manager, Invesco Oppenheimer Developing Markets, all topped their targets. On the real asset front, you can see the composite lagged a little bit, rising 15.1 versus 16.4%. And that was because the Prudential Global REIT Fund lagged its target index by about 1%, up 10.8 versus 11.9. Your S&P Natural Resources Index was up 31.4%, matching the rise of the index. So, it was a very solid quarter of performance, really good to see the rebound. Now I would really like to see that investment management team making up the 1.8% performance gap versus the blended target. Any questions on performance of the fund before I touch on asset allocation briefly?
I don't see any. I think you can continue.
Okay, so the flash report, which we sent out for June 30th, shows you the asset values of all of your investment managers. And there you can see that, again, as I mentioned, total assets ended the quarter at $140.3 million, up from $137.6 or .7 million at the end of May, and up from 124, maybe .3 million, if I'm remembering correctly, from March 31st. You were 2% overweight your equity target, your long-term strategic equity target, as equities rebounded very strongly and outperformed fixed income. So you're at 50.4% at the end of the quarter versus a 48% target in total equity. Your operational cash, the Pinnacle cash account on the flash report, is $3.2 million. It's overweight in the strategic asset mix, 2.3% versus a target of 1. As you might recall, even throughout last year, we were trimming assets and building operational cash such that you had 9 to 12 months of cash on hand to pay benefit payments and other plan expenses and not have to worry about liquidating into a weak market. I mean, last year it was a matter of trimming profits and not having any idea that the first quarter was going to be what the first quarter was. But the fact that you already had a cash stash, if you will, built up in the first quarter was very positive, because the plan didn't have to worry about liquidating into a weak market. And we may be in a position in coming months to do some more profit taking. I didn't think I would say that in 2020, so we'll just have to see how it goes. We did not make any rebalancing recommendations for the month of June, because we are discussing an allocation to U.S. REITs and potentially an addition of a fixed income strategy to your fixed income team. So if the committee makes a decision on either of those investments, when we do the funding, we can also use that as a rebalancing opportunity. Any questions on the asset allocation or the monthly flash report?
No, I don't see any, Natalka. Thank you.
Okay, so I was going to move on to the REIT fund update that we provided, and so you should have two reports in front of you. One is the original REIT fund search that we provided at the last meeting, and you might recall that that REIT fund search, we looked at 19 years of performance when we screened for managers. So we were fortunate enough to find a number of very good REIT managers that have a 19-year track record, which is great. And we reviewed the 4 finalists, and that were Cohen & Steers, Principal Real Estate, DSA, Real Estate Securities, and Vanguard Real Estate Index Fund. And I am happy to review any part of the original report or the thesis for why we're looking at U.S. REITs. You currently have global REIT exposure. You've had global REITs in your portfolio for probably 10 years now, and they've done well for you. When we conducted the asset liability update about 2.5 years ago, the study showed that REIT or real estate exposure should increase from a target of 7 to 17 in your strategic asset mix. We've been building an overweight in global REITs as we have evaluated both the direct real estate market as well as the public REIT marketplace. And at this point in time, we thought going with a public U.S. REIT fund was better than private real estate because of liquidity. There are no lockups, fees, and also the sector allocation that you're exposed to with public REITs versus direct or private REITs. In the past few years, the real estate market has changed in that segments or sectors such as data centers, cell towers, life sciences, data storage, and other types of storage, those have been expanding and driving sectors in the real estate market. Currently, direct real estate does not have as much exposure to those sectors as a public REIT fund does. So we thought best, if we wanted to take advantage and have good exposure to those sectors, to go with a real estate option, and U.S. focused, because you already have a good global real estate focus. And so that was the rationale for public versus private REITs. The committee in reviewing, when we reviewed the original report, was correct in noting that the statistics that we provided, and on the original report, that was page 4, summarized a lot of the performance and risk statistics. It covered the trailing 10-year period. And when you looked at the annual returns for that period, they were pretty much all positive, an upmarket, if you will, for real estate. Other than 2018 and the first quarter of 2020, you really didn't see a super difficult or bear market or down market in real estate. So the committee astutely asked the question, well, how does real estate perform in a bear market? So we went back and we updated this search, if you will, focusing in on the 2005 through 2010 period. And if you open your updated REIT fund report and you go to page 2, you'll see the updated performance tables and risk tables and sector allocation tables. And you'll see on the top of the first table on page 2, the annual returns from 2005 to 2010. And it very clearly shows that in 2007 and 2008, the difficulties that real estate went through during the financial crisis. Flanking that, you can see that real estate in 05, 09, 10 very strong years of performance, and then in your original study, the annual returns pick up from 2011. So you now sort of have 14, close to 15 years of individual annual returns to look at, as well as trailing period returns. So if you look at Table 2 from the updated study and Table 4 from the original study, you can see how the trailing period returns have changed, and also some of the risk statistics have changed. As well as you can also comment on how the sector allocation has changed in the real estate market. Going back to 2005, there wasn't as much need for data centers and data storage, and cell towers were around. They were grouped in a sector called diversified. I guess I'm going to, just sort of pause here. I can make some comments on the performance comparisons and the risk comparisons, but I would just, in case anybody had a question on any of the comments that I've made so far.
I don't see any questions.
Okay, I'm just assuming that everyone is studying all these numbers, but a couple of things that sort of stood out was even during the, what I'll call the shortened period, the 2005 to 2010 period, if I look at the trailing 5 or 6 year returns, some of the same firms that are top performers through the whole period were also top performers during a period that was quite difficult. So Cohen and Steers and Principal had trailing 6 year returns during that time period of 5.9% annualized. If you look at the longer study and you look at either the trailing 5 or the 7 year return, you'll note that the trailing period returns are actually quite similar, even though it's a different endpoint, so a different period of trailing returns. That, may give you some information on sort of the consistency of long-term performance given both weak and strong markets. So some of the same players that were top performers in the shorter period are still the top performers, through the overall period. And also during the downturn periods, you'll note that Cohen and Steers in 2018 was pretty defensive, as was Principal. And both of them were not quite as defensive in the downturn in 2007, but everyone was in a pretty tight range in 2007. The index was down 15.7, and everyone else sort of was down between 16.4 and down 19.2. From a risk standpoint, if I look at alpha, 6-year alpha of the 2005 through 2010 time period, it's much lower than the alphas in the overall report. So, and you actually have one slightly negative alpha. So alpha is a measure of one of the measures of risk-adjusted return. You'll also note that the beta and the standard deviation, so two dedicated, if you will, risk statistics, both of the risk statistics were higher during the shortened period, which captured two of the significant downturns, than the standard deviation and the betas are in the longer time period. And in some ways, that's not surprising. You know, the longer the time frame, you're going to have more up markets than down markets, and so the risk statistics should look, you know, a bit better over longer periods of time. From a sector standpoint, you'll notice that there is not sort of a separate area for data centers, there is for data centers, but for cell towers, or, you know, and that has been an index that's really, or a segment of the index that's really come into its own. You can see how small it was in 2005 through 2010 versus the size of it now. It's about doubled, and that's just in cell towers. Data centers have also increased significantly. Self-storage has increased a bit, not quite as much as the other two. Healthcare has increased in some regards. What has really sort of come down is if you look at the retail sector, which has been a weak performing sector for REITs for the past 3 or 4 years, even before the recent downturn with all of the shutdowns, the Amazon effect, where more people were doing internet shopping than they were bricks and mortar shopping. The retail sector has gone from being about 22 to 27% of the indices down to 17 and 9%. So quite a fall off in retail.
Metallica, you've given us a lot of information, no doubt, and we appreciate that. It seems to me that the two that continue to stick out in a positive way are Cohen and Steers and Principal Real Estate, and it comes down to them. I guess the question is for us, and we've got, if I looked at your allocation correctly, we're going to invest $14 million thereabouts. It's 10% of our portfolio in this segment. Is that correct?
Well, currently your target for real estate, and that includes the global, is going to be 17%, and you're at about 10.5% in the global REITs now.
So 7% then of that.
Right.
Half
so
of that,
potentially
7 million, 8 million, something like that.
Yes, and you know, you don't have to get there all at once, and this is also not to say that there might not be a direct property opportunity that comes up in the future, but for the purposes of your question right now, potentially 7% would go into this.
Okay. So $7 million, whatever, somewhere in that range. I don't know. We just need to get off the dime here and pick one of these, I think.
Well, do we have to pick one, or can we allocate between?
Well, that's another question. The amount, that's the reason I was wondering about that.
We've done that before.
Yeah, split them.
We got down to two that we really liked, and
Yeah.
we split them.
Does that make sense?
You can certainly do that. One of the things that, I'll point out is one of the things that makes them a little bit different, while their returns look similar and their risks look similar, where they differ is in the sector allocation. So if you go to page 4 of the original and the longer-term study. So, for instance, Cohen and Steers currently has 5.2% in office. Principal has 11. Industrial, Principal has 16. Cohen and Steers has 8. They both have about the same in retail. And when it comes to self-storage, when it comes to cell towers, Cohen and Steers has built up more exposure in those sectors than Principal has. So they're a good, if you will, complement to one another from the standpoint that you're getting exposure to some different sectors. Cohen and Steers has rotated more quickly into the sectors that are outperforming most recently, or I should say the past couple of years. It's not just been one quarter. And the other thing is, and it's not that principal's not there, they're there, and they may increase that. Office space might be another sector that is influential in the next couple of years. It remains to be seen how this lockdown and how the working from home and remote working is going to impact office space. And Cohen and Steers has sort of backed off of that sector, whereas Principal is still more heavily involved there.
Which seems
bottom
wise.
line, it's sometimes unfortunate for me, it's hard to give a short answer.
Yeah.
So that's probably more than you wanted to know. But they are a good complement to one another because you're not, if you will, just overlapping and, investing in the same thing.
May I interject something?
Hi,
We're
Earl.
buying this for the long term, and if you look ahead at our political parties, they are both calling for the reindustrialization of America. No matter who you listen to, that seems to be big on everybody's agenda, which means we'll have to have space for that, and it may be in the current time looking at too much industrial doesn't look good. But what are we talking about 5 years from now?
Yeah, and again, if you split them, you kind of get the mix of that too. I think that's the positive thing. The other is, what about health care? Is that good or bad? Who knows?
Yeah.
Do both, you dilute.
You got to like the office mix in favor of Cohen, the industrial in favor of Principal if you're looking for that. So.
I agree. I had narrowed it down to those two as well.
Yeah.
And their ratios are very similar.
Yeah, performance has been.
Rich was just asking me here, to maybe comment on staff and manager tenure, and both Principal and Cohen and Steers are quite strong. Their teams have been in place a long time. I mean, Principal is close to 20 years, the same team. Cohen and Steers had a retirement of a senior person a couple of years ago, but one of the senior managers there, has been on board since inception. So both of them are good from, a manager standpoint. Both of them, they're the two active managers in the mix. So from an expense standpoint, very similar, but higher than DFA and Vanguard, which Vanguard is an index fund. DFA, if you recall, very systematic, very quantitative approach. So,
And Principal was the most expensive, weren't they?
Pardon me?
Principal was the most expensive,
They are.
right?
Right, by 2 basis points. I mean, we can try to beat them up a little bit on your
between the
behalf, and
Yeah.
we're happy,
It's a fun, you can't beat them.
Yeah, it is a fund, so I don't think I'll have too much room. No beatings, Rich says.
What do you think about the split, if we just went half with each one?
I think that that's good. As you and Earl indicated, there's some good offsets, and so we can sort of see what happens with office and industrial and healthcare space as we move forward. It does also have the effect potentially of diluting some of the return, but I think that what you make up in giving yourself the additional coverage through diversification, it takes pressure off of picking the quote-unquote exact right one for the next few years, because that's always hard to do.
There's another real estate. What's the current real estate?
Prudential, global.
And how much will be the total allocation to real estate with
17.
REITs? With REITs. Okay. So you're going to have 17% of assets you would have spread over 3 funds. The global sort of stands on its own because of the multinational nature of those assets. These two, there's a little bit, you all picked up on this. I think that there's a little bit of an issue with, what do you favor? The industrial is clearly, there's a different office, there's a clear differentiation in terms of current allocation and cell towers. So if you're attracted to their mix at the present time, then that speaks for that manager. The teams are good. They're both, unfortunately, very expensive funds compared to the other two. I think that 17% of assets spread over three managers is not unnecessarily diversified. It's essentially 6% on average per manager, which I think is a solid allocation number. So I like the diversification move, even though it adds to the mix of managers. It's doing so in a way which still leaves you with meaningful exposure to each one, and we'll be able to observe as we move through time in the next 3 years as the markets evolve, as we move through this period of time, the pandemic, which of these two managers have really, called the shots, called the tunes. So I like the diversification into the two managers myself, even though it leaves you with some expensive...
Let me make a motion that we split our investment between Cohen and Principal.
Second.
The amount available.
Okay. So we've got a motion and a second. All those in favor vote aye.
Aye.
Any opposed? Seeing none. Okay, let's move on to item C, the Western Credit Opportunity Strategy Bond Fund information.
So
Before we go there, can I ask a question?
Yes.
Can you, between the two parties that we're splitting there, can you direct them into what market you want to go in?
No. It's like a
They
mutual
choose?
fund.
Okay.
That's just
them
what
money and they
they
do.
decide.
All right.
Yeah.
Right,
Good
yes,
question, though.
it is these are all public mutual funds, so they'll follow the rules and sector allocations and such that are outlined in their prospectus, and they, as Melissa correctly stated, they do call the shots within the guidelines of the prospectus.
But we can track that sector mix to sort of give us some profile each quarter as we review how they've done.
That will be interesting to look back in
It
a
will.
few years and see
Yeah.
who made the right calls, or if they ended up getting closer together than they are now.
That's true.
I think that a little bit, not a deep dive necessarily, but an overview. Let's talk about Western Credit Opportunity Strategy Fund. This is a different approach for Chartwell. We're coming to you with a recommendation to invest in a single fund, single manager, single strategy, as opposed to sort of a more the typical top-down approach like we've just completed here with the REIT search, where we've identified the asset class, discussed its allocation, and then we've identified a series of finalists for you to look at. This is a little bit. This is a one-off approach for us. Western has brought us into the picture on this fund that they're doing. Western is like TCW. It's a very strong, institutionally oriented fixed income manager. We've had clients invested with them since 1994. Yeah. So we know them pretty well. And they're putting together a fund that, unlike most times when you're institutional fixed income manager, where you're kind of tied to benchmarks and volatility targets because of clients like you and consultants like us. This is an open-ended, if you will, fund in terms of volatility target and pure market benchmark, and that's because Western feels that the market has become significantly dislocated by the actions of the Fed since March. Vitelka mentioned it. The Fed has injected $6 trillion of lending, purchase, and credit support programs to backstop credit markets and provide liquidity to keep the bond markets operating efficiently. And they've been very successful. There's never been a time in the last century when that kind of level of injection of support for the markets has taken place. We're a $19 trillion GDP country, so $6 trillion of one-off of credit support by your central bank is a very big deal. It's had a lot of impacts around the edges of the bond markets, and the credit bond markets in particular. Western feels that for the next couple of years, an unconstrained, to a degree, approach towards credit market where they put their best people, give them the mandate to develop their best total return ideas, and allow them to invest in a fund which is really not that large by their standards. $500 million, $500 million fund for a firm of this size is, not at all large. Think about some of the private equity firms you've read about who just closed on $20 billion private equity fund. We're talking about a $0.5 billion fund. So we've got a small fund. They're going to invest in 4 stratas of the credit-related bond markets, U.S. only, public bonds or public securities, publicly traded, not private credit, and with, I think, some favorable overall terms and conditions for investors. And so we have this opportunity with our clients, us and many others, but including us, to put this in front of our clients. So we decided to do so. I think we've talked about this with 5 or 6 of our clients, including yourselves. And we detailed the portfolio, what they're going to invest in. There's their book, which we helped them to write, so to take out the marketing elements of it. We have a presentation to you on page 2, which identifies what they're going to be investing in. There's bullet points on page 2. These are all the security categories that they might invest in. There's no limitations on their allocations. They have given indications down below, the bottom of page 2, sample portfolio allocation percentages. You can expect generally to see about 30% of assets in high-yield bonds, 20% in investment-grade bonds, credit bonds, 30% in bank loans and CLOs, and those will be largely either high-quality, high-yield. I know that's a contradiction, but high-quality, high-yield, or investment-grade, low investment-grade, that would be BBB bonds, and then mortgage and asset-backed securities, 20%. So you can expect that kind of a portfolio mix in terms of broad allocation. The actual specific investments are delineated in the middle of page 2. And so we think that this is kind of a very interesting opportunity to diversify your bond exposures by investing in a best ideas fund with a top caliber manager, and that's what we're proposed to do. That's why it's different. It's a one-off in that context, but it's a one-off that we think is a very attractive.
Right, and one of the reasons why it's being offered, if you will, in a private structure versus a 40 Act fund is Western wanted to bring this to the market in a very timely fashion because credit markets and markets in general move very rapidly. They wanted to take advantage of the dislocation opportunities. So it was easier to put forth in an LP or a private structure. But as Rich mentioned, all the underlying investments are publicly traded securities, will be publicly traded securities. And there's, the fees are reasonable. And the liquidity
Well, the liquidity terms are unlike a normal private fund. That you'll be able to pull out 25%. You can expect to be able to pull out 25% of your assets per month. So over a 4-month period, you could potentially fully liquidate the portfolio. It's not daily liquidity. It takes 5 days notice to get any money, but you, with 5 days notice, could pull out 25% of assets. So it's not really an illiquid portfolio at all. It is, however, an investment strategy which I think requires the patience of at least a couple years in terms of looking at it. It's not, and Chuck asked me this morning, is this an evergreen fund? Is this meant to be in perpetuity invested like the TCW Total Return Bond Fund? That's an in perpetuity mutual fund. And I think that the answer is it's both. The answer is both. If you ask Western, if the opportunities in the space dissipate and they're no longer able to bring alpha into the mix, which is excess return versus risk, then that might be time to gradually exit the portfolio. If, however, we continue to get good returns and experience from it, there's no reason to liquidate it inherently, although you'll be able to as an investor, as I said, over at least a 4-month period. You have to expect to be at least 4 months. So
I've got a question, and I want to limit this to a 1-minute answer, but
okay.
Having read The Big Short and remembering mortgage-backed securities, what's the status of that market in terms of underwriting, quality, that sort of thing?
You know, the status of the mortgage-backed security market in terms of underwriting quality is very different today than it was in 2007 and 8. Now, it's a function of, what we as consumers, whether our credit worthiness holds up. And, that's a complex answer, right? We don't know what the unemployment rates are going to go to. Right now, they're quite high. They're double digits. But in terms of underwriting standards, it's a different place. And
it's not the Wild West like it was in 2008 and 9, is what I hope you're telling me.
That's exactly what I'm telling you.
Okay, that's good enough for me.
It's getting there.
Yeah. Really.
Anybody that read or saw The Big Short, and I did both, Ooh.
I have a question, too, about the allocations. We've got 30% in high yield. How does that affect our allocation to Lord Abbett high yield, which we're targeting 4%? We're already at 5.4, or 1.4 over our target allocation. And the other question regarding high yield is they seem to be a little closer correlated to the equities market. And if we're going into a recession, do we want to have that allocation to high yield? And then my other question regarding allocations is concerning the bank loans. And if I'm remembering correctly, those are typically floating rate loans tied to LIBOR with a floor. And I'm wondering how far away we are from that floor before we start seeing an increase in the value of these bank loan funds.
Whoa, okay.
Okay, so
I'm going to try to keep score here.
Yeah.
First of all, I think your observations about high yield, let's cover that. We'll get bank loans at the end. The old policy was 7. Reacting to just what you said in terms of concerns, the new policy was reduced to 4, and that's where you're heading towards. We would invest in this new fund by pulling some money from the high yield fund, bringing its allocation down to 4. So rather than leaving it at 5.4 static, we would reduce that to 4. That would be one of the funding sources for this new investment.
Okay.
So to your point about managing high yield exposure overall and being cognizant of the fact that this is going to have some in it is an important one. So the way to manage that is to basically reduce your high yield and put it into this. You'll get a different portfolio because it's a different team of people doing different things overall. So rather than being at 5.4, you'd be down to 4. So that would be a funding source. With respect to the other funding sources, the policy is the target is to move PIMCO and Brandywine from current allocations of 3.4 down to 0. So that would be, in our minds, another funding source for this portfolio, because you're headed that way anyway. And then finally, the last funding source that we would recommend to trim would be TCW, total return. We could be Pinnacle or TCW. We think TCW is easier to manage. Now, you could further reduce Lord Abbott from 4 to below 4 in order to provide that funding. So managing high yield exposure overall started with the reduction of targets from 7 to 4, and we're heading in that direction. So that's I think the high yield. Is that did I help to answer your question with that?
Well, and now what?
Yeah, I think that's fine for the funding sources.
You were right about
When we get the flash report after the investment into this Western fund, how will the allocations be broken out so that we can determine how we are aligning to our policy allocations? Will we have a line item that just says Western Asset High Yield Fund, or will it show how that fund is being broken out in accordance to our policy allocations?
I think
and the reason I'm saying is this seems to be somewhat of an unconstrained fund, so while they are saying their sample allocation is 30%, they could go over that. Is that correct?
Absolutely.
So therefore, by the management in this one fund, it could cause us to be over-allocated in high-yield funds if they chose to go higher than the 30%.
Yes, if that was one of their best ideas, that's absolutely right.
Okay. And again, I guess that's my concern, is just how do we manage the allocations among the various fixed income classes if we're just looking at the Western Fund alone. Does that make sense?
It makes more sense to look at the combination of all of your managers taken together, and to not get caught up in looking at one manager and deciding that we've got to manage that allocation mix. You're not going to have any say into how these monies are managed, but we can track, just like we talked about the sector allocation real estate, we'll be able to track what percentage of assets of this fund are invested in the 4 primary categories each quarter. When we talk with the firm, meet with them and discuss the portfolio, we can build that into an overall review. But and we in fact do that, don't we? We look at the asset mix of each of the TCW and the Pinnacle funds, right?
Yes, we do. So we sort of track it underneath the hood, and in some ways it would be similar to the fact that you have 2 global equity managers, and so that they invest both in U.S. equities, developed market, and one of them invests also in emerging market equities. So we sort of track and keep an eye on, your exposure to domestic equities and emerging markets to make sure they don't get too horribly overweighted.
Okay.
So it'll become part of the mix in terms of the light item, the index benchmark that we want to compare it to. We'll develop that and propose it to you after the fact.
I like the idea personally.
Yeah.
I think it's, with the track record and the recommendation of Chartwell, and I think Scott makes great points again about asset allocation within the fund, but if we're able to...
If it deviates, we can always...
And we can get out. We can get 25% of our money with 5 days' notice. So I guess the next question would be then, if we do decide to go there, how big do we want to go? We want to start with the initial $5 million is like the minimum investment, it seems.
Yeah.
It looked like $8 million would be available if I just did some rough calculations based on your takedowns. And is that a ballpark number?
Yes, I think that a 5% allocation to this fund would be meaningful enough to make it, potentially make a difference in your fixed income portfolio returns overall. So 5% of 140 is 7. 8 is a good number. I think we can fund to 8 without issues.
That's the closeout of 2 and the takedown of Abbott, Lord Abbott.
Good.
That's correct. Plus, for anything else, we would move it from TCW. I would not want you to move it out of cash because I like the fact that you've got all the liquidity you need for the next 9 to 12 months. I don't want to do anything to
Motion.
I think we're ready for one.
I'll make a motion that we invest these funds as discussed in the Western Credit Strategy Bank.
Second?
I'll second.
Okay, all those in favor, vote aye.
Aye.
Any opposed?
Yes.
Okay, Scott's opposed. Okay, well, the motion carries. So, Natalka, if you'll get with me and let me know what you need from us to get this set up, I'll try to get it turned around.
We'll be back to you later today with that.
Okay. Okay, is there any other business to come before the committee? Seeing none, we'll stand adjourned. Thank you, Chartwell, for all of your information today.
Thanks for the time, and everybody stay safe, healthy, and have a great summer.